What if I told you that silver was never cheap? What if the price you see on your screen right now, $22, $24, $26 an ounce, is not a market price at all? What if it's a permission slip? A number is chosen, maintained, defended, not by supply and demand, but by leverage, margin calls, and financial violence. Because here's the uncomfortable question no one on CNBC wants to ask. If silver is abundant, why is it disappearing? If silver is just an industrial metal, why are sovereign nations hoarding it like gold? If silver is too volatile, why does it explode every time the system cracks? And here's the question that should make your stomach tighten. Well, what if the real silver squeeze already happened quietly, and the only people left holding paper promises are you and me? What if the biggest wealth transfer of the next decade is not happening in crypto, not in AI stocks, but in a metal that Wall Street told you was boring? Because silver isn't boring. Silver is dangerous. It exposes lies. It breaks leverage. It destroys confidence games. And that's why it's been kept in a cage. Look around you. Food prices are up. Rent is up. Jobs are fragile. Debt everywhere. Your paycheck buys less, but your screen says inflation is cooling. Sound familiar? This is the same feeling people had before 2008, before 1971, before every monetary reset in history. And yet somehow, silver, the metal used in solar panels, EVs, weapon systems, medicine, and data centers, is priced like it's unwanted. That contradiction is not an accident. It is a signal. And today, we're going to trace it. From the shadows of the COMEX to the vaults of Shanghai to the moment retail traders woke up to a brutal truth. You don't own silver unless you can touch it. Quick pause. Community check-in. Where are you watching from? USA? Europe? Asia? Drop it in the comments. I read them. And if you want the unfiltered truth about money, metals, and the systems designed to extract from you, hit subscribe now. Because this channel does not sell comfort. It sells clarity. Now let me take you back to the first lie. For most of human history, silver was money, not an investment, not a hedge. Money. Rome paid its legions in silver denarii. China ran entire dynasties on silver ingots. The Spanish Empire mined the New World into monetary dominance using silver. Silver didn't just facilitate trade, it disciplined governments because you couldn't print it. And that was the problem. Fast forward to the 20th century. Governments discovered something intoxicating. If you separate money from metal, you can spend without limits. The US quietly removed silver from coinage in 1965, then gold from the dollar in 1971. And suddenly, money became elastic. Debt exploded. Deficits normalized. Banks grew fat. Sound familiar? But silver remained a problem. Because unlike gold, silver is consumed. Every solar panel, every circuit board, every missile guidance system. Once it's used, it's gone. So what do you do? When demand is rising, supply is finite, and honest pricing would expose monetary fraud, well, you don't let the market decide. You replace price discovery with paper. In the 1970s, futures markets exploded. Originally designed for farmers, they became playgrounds for banks. Silver futures allowed something unprecedented. You could sell silver you didn't own, not once, not twice, hundreds of times over. 1 ounce in a vault could be sold 50, 100, sometimes 400 times on paper. This wasn't a bug, it was the feature. Because as long as contracts were settled in cash, no one had to deliver metal. The illusion held until it didn't. In 1980, the Hunt brothers tried something radical. They demanded physical delivery. They bought silver, lots of it. The price exploded from $6 to nearly $50, and Wall Street panicked. And what happened next is crucial. Rules were changed mid-game. Margin requirements were jacked up overnight. Only liquidation was allowed. The price collapsed. The message was clear. You may speculate, but you may not expose the system. Sound familiar? Because this exact playbook comes back again and again and again. Fast forward to today. COMEX silver trades hundreds of millions of ounces daily, but registered physical inventory, a fraction. Days where 100 ounces trade for every 1 ounce delivered. Sound familiar? Retail buys SLV, thinks they own silver. They don't. They own a claim. On a claim, on a custodian. Who can settle in cash and who controls the paper? Bullion banks, names you know, JP Morgan, HSBC, Scotiabank, formerly. These banks hold concentrated short positions so large that if silver were honestly priced, they'd be vaporized. So the price must stay low at all costs. And this is where China enters the story, quietly, patiently, relentlessly. While Western markets play paper games, China does something radical. They take delivery, they build vaults, they drain supply from the shadows. No headlines, no CNBC panels, just metal moving east. And here's the part no one wants to say out loud. China doesn't need silver to be cheap forever. They just need it cheap long enough. Sound familiar? Because history doesn't repeat. It rhymes. Up to this point, everything you've heard still fits inside a story most people can emotionally tolerate. Banks manipulate. Markets are rigged. China accumulates quietly. Uncomfortable, but familiar. But now we cross the line where plausible corruption becomes coordinated design, because the silver story does not pivot on a metal shortage. It pivots on a weapon so clean, so legal, and so devastating that it never makes headlines. The weapon is marginal, and in silver, margin isn't a safety tool, it's a kill switch. Let's rewind to a moment most retail investors remember emotionally, but not structurally. 2020, 2021. Pandemic panic. Money printing on a scale never seen in human history. Interest rates crushed to zero. Stimulus checks raining from the sky. Silver explodes. From under $12 to $30. Physical coins vanish overnight. Premiums disconnect from the spot. Online dealers sell out. Delivery delays stretch into months. This is the moment silver should have escaped the paper cage. This is when honest supply and demand should have reasserted control. And yet, it didn't. The price stalled, then reversed, then collapsed. And most people were told a comforting lie. Just profit-taking. Just volatility. Just markets being markets. That explanation is fiction. Because behind the scenes, something surgical happened. If you've never traded futures, this part matters. Silver futures contracts represent 5,000 ounces per contract. At $25 silver, that's $125,000 worth of metal. But here's the trick. You don't need $125,000 to control it. You only need margin, and margin is not fixed. It is political. In early 2021, as silver demand surged and physical shortages became undeniable, the exchange quietly made a move. They raised margin requirements, not gradually, not transparently. They raised them aggressively and repeatedly. In some cases, overnight margin jumped toward $25,000 per contract. Think about what that does. Retail traders, leveraged, excited, finally right, suddenly needed tens of thousands of dollars per contract just to stay alive. They weren't wrong. They were underfunded. So what happens? Forced liquidation. Margin calls don't ask for your opinion. They don't care about fundamentals. They don't care that silver is scarce. They only care about cash, right now. And when enough people are forced to sell at the same time, price collapses. Here's where the conspiracy sharpens. Raising margin during extreme volatility is normal. Raising margin during physical shortage is not, especially when vault inventories are tight, delivery demand is rising, and short positions are under stress. Margin hikes in that moment do one thing. They protect shorts. And who holds the largest concentrated shorts in silver? Bullion banks. The same ones that custody ETFs, clear futures, advise governments, and sit on central bank committees. This was not about stability. This was about survival. Because if silver had broken $30 decisively, margin wouldn't have mattered. Delivery would have. And delivery is where the system breaks. Paper silver can expand infinitely. Physical silver cannot. Every futures contract has a delivery clause. But most traders never stand for delivery. They roll, they cash settle, they speculate. The system relies on this behavior. But during 2020, 2021, something changed. People wanted metal, not ETFs, not promises, not paper, metal. And when too many people demand delivery at once, the exchange faces a nightmare. Default or expose the fractional reserve. Margin hikes stopped that clock. They flushed out weak hands. They crushed retail morale. They slammed the price just enough. And the headlines declared silver squeeze failed. That statement was a psychological operation. Because the squeeze didn't fail, it was contained. While Western traders were being margin nuked, China did nothing. No social media campaigns, no Reddit hype, no leverage, just delivery. The Shanghai Futures Exchange works differently. Physical settlement is normalized. Contracts are backed by metal flows, not just cash offsets. And China's silver imports, they don't come through COMEX headlines. They come through Hong Kong, Latin America. Long-term bilateral supply deals. Silver doesn't spike when China buys. It disappears. And here's the crucial distinction. Western markets trade price. China trades metal. One creates volatility, the other creates ownership. This is where most conspiracy narratives go wrong. They assume the price is meant to stay low permanently. That's not true. The price is meant to stay low until positioning is complete. Once the metal is in the right hands, suppression becomes unnecessary. In fact, it becomes dangerous. Because when the world realizes silver is scarce, those who already own it don't want a slow rise. They want a repricing, a violent one. Here's something subtle. If silver were irrelevant, why does every major spike get met with coordinated margin hikes? Sudden sell-offs at illiquid hours, massive paper dumps at 2 a.m., No industrial commodity trades like this. Copper doesn't, oil doesn't, lithium doesn't, silver does. Because silver is not just a commodity, it is a monetary shadow, a metal that reminds people money used to be scarce, discipline used to exist, and systems used to break. That memory is dangerous. Now we reach the edge of the cliff, because every margin decision, every rule change, every emergency action has a signature, not a conspiracy board, not a secret cabal, a name, a committee, a mechanism so boring on paper that no one questions it. But once you see it, you can't unsee it. Because this entity doesn't just manage silver, it manages confidence. And when confidence fails, everything reprices. So who authorized the margin nukes? Who decided when silver was allowed to rise and when it had to be crushed? Who sits at the intersection of futures markets, central banks, bullion banks, and emergency stability measures? The answer isn't who you think. And when you hear the name, you won't believe the name. The receipt is wilder than you think. The CME Group. Yes, that CME. The Chicago Mercantile Exchange, the institution that owns COMEX sets margin requirements, defines orderly markets, and decides what qualifies as an emergency, not a government agency, not elected, not accountable to voters. A private exchange cartel deeply intertwined with bullion banks, clearing members, central bank counterparties. They don't just host markets, they design outcomes, and margin is their scalpel. Let's strip the illusion. When people say silver is manipulated, skeptics respond, you can't manipulate a global market forever. That's true, unless the market isn't physical. COMEX silver is a derivatives market, not a metal market. Here's how 1 ounce becomes 100. A futures contract is created $5,000 odds. That contract is traded, retraded, and rehypothecated. D. The same underlying a deliverable silver is pledged multiple times. Most contracts are never delivered. They're closed in cash. Result? Paper supply expands infinitely. Physical supply does not. This is fractional reserve banking applied to metal, and it only works if most participants never ask for delivery, price remains low enough to discourage hoarding, and volatility is weaponized to flush weak hands, which brings us to inventory. COMEX reports 2 numbers: eligible silver, registered silver. Most people don't know the difference. Eligible talker silver stored in COMEX approved vaults. Registered Handelskarm silver actually available for delivery. Here's the trick. Eligible silver does not belong to the exchange. It belongs to someone else. It may never be for sale. So when you hear there are 300 million ounces in COMEX vaults, that means nothing. The only number that matters is registered. And there have been moments, documented moments, where registered silver could not cover even a single month of delivery obligations. That's not tight. That's fractional collapse territory. Here's a number Wall Street hopes you never look up. There have been periods where the ratio of open interest to registered silver has exceeded 100.1. Translation: for every ounce available for delivery, over 100 ounces were promised. In any other industry, this is called fraud. In finance, it's called liquidity. Skeptics ask, if it's so broken, why hasn't COMEX defaulted? Because default is not binary. It's managed. The system has escape hatches, cash settlement incentives, emergency margin hikes, position limits, enforced selectively, rule changes mid-game. Default is avoided not by strength, but by confidence management. As long as participants believe delivery is possible, most won't try, but belief is fragile, and once broken, it cannot be repaired. Now let's add jet fuel. Silver doesn't just trade on COMEX, it's also lent swapped, used as collateral pledged across multiple balance sheets. The same bar can be owned by a bank claimed by an ETF, promised to a futures buyer all at once. This is rehypothecation. It works beautifully. Until someone asks, can I have my metal? At that point, someone else doesn't get theirs. And that's when markets freeze. Let's be precise. This system benefits bullion banks that earn fees on volume governments, that suppress monetary signals, central banks that need faith in fiat, industrial buyers who want cheap inputs. It does not benefit savers, wage earners, retail investors, anyone trying to preserve purchasing power. This isn't incompetence, it's alignment. China understands one thing better than the West. Paper claims are only as strong as trust. They don't need to smash COMEX. They don't need headlines. They just need to drain metal quietly, and they have, over decades. While the West financialized silver, China stockpiled it. While the West sold paper, China took delivery. While the West chased yield, China chased material security. This is asymmetric warfare. Now let's talk price. Not fantasy, not moon memes. Math. Silver hit $50 in 1980, adjusted for inflation, over $180 today. Now factor in monetary base expansion since 2008, industrial demand explosion, solar, EVs, AI infrastructure, declining ore grades, underinvestment in mining, and decades of suppressed price signals. $100 for silver isn't extreme. It's conservative. In fact, if silver were priced like gold relative to historical ratios, we're not talking $100, we're talking reclassification. Here's the final mechanical truth. Suppression works only if metal keeps flowing, confidence holds, and demand stays manageable. But today, industrial demand is non-negotiable. Mining supply is inelastic. Sovereign accumulation is accelerating, and retail is learning the rules. This isn't 1980. This isn't 2011. This is a globally synchronized system, running on borrowed time. The system doesn't fail when everyone panics. It fails when smart money exits quietly, dumb money feels safe, and price looks stable. That's when inventory drains unnoticed. That's when leverage builds invisibly. That's when repricing becomes unavoidable. And when it happens, it won't be announced. So now you understand the mechanism, the illusion, the weaponization, and the silent accumulation. All that remains is the warning. Because systems like this don't end politely. They end suddenly. Here's the most dangerous lie in modern finance. If something were truly broken, it would have already collapsed. That belief has destroyed more wealth than any crash. Because systems built on borrowed time do not fail early. They fail late, they fail fast, and they fail all at once. Silver is not the cause of what's coming. Silver is the signal. Every paper promise layered on silver bought the system time. Every cash settlement delayed accountability. Every margin hike kicked the can. But time borrowed is not time erased. It accumulates pressure. And pressure does not dissipate quietly. It releases. Suddenly. Think about where we are now. Debt levels are higher than ever. Interest rates weaponized but ineffective. Central banks trapped between inflation and collapsed supply chains are fragile. Trust them. This is not a stable environment. It's a tension field. And silver sits at the fault line. Institutions don't fail because they are stupid. They fail because they are incentivized to deny. Denial is not emotional. It's structural. Admitting silver is scarce would mean admitting money is broken, admitting price signals are distorted, admitting decades of policy were wrong. That's not just reputational risk. That's regime risk. So denial persists, right up until it can't. This is critical. The next break will not be a bank run you see on TV, a single layman moment, a neat timeline with explanations. It will be sudden delivery failures, temporary trading halts, rule changes framed as stability, and price gaps that never fill. By the time it's obvious, positioning is already done. Silver doesn't just expose markets, it exposes human behavior. We prefer comfort over truth. We prefer narratives over math. We trust institutions because questioning them is exhausting, but history is ruthless with denial. Every civilization that debased its money eventually lost control of its future. Not immediately, eventually, let's be precise. No one can tell you the exact date silver reprices. But we know the conditions. When delivery overwhelms paper, when margin loses effectiveness, when trust evaporates faster than liquidity, that moment doesn't ring a bell. It snaps. And once it does, there's no reset button. So now you have to decide. Do you trust a system that must suppress signals to survive? A price that exists only on screens? Institutions built on leverage and denial? Or do you trust scarcity physics and history? Because silver doesn't care what you believe. It only cares whether you're positioned before belief changes. If this made you uncomfortable, good. That means it mattered. Share this with someone who still thinks markets are fair and prices are honest. Subscribe if you want analysis that doesn't protect institutions, only your understanding. And leave a comment. Are we wiser now, or walking the same path in better suits? Because the suits are sharper, the leverage is higher, and the clock is louder than it's ever been.